things we do. We're going to talk about today's jobs report, and this, if you don't mind, is a technological experiment. We're trying to do this live on Facebook, Instagram, and what other social media are we using? Twitter and YouTube. So there are multiple ways to do this. If you wouldn't mind holding on a second, I'm going to tweet out the link, which doesn't happen until we go live here. And of course, it's not here now. Is that normal?
It takes a minute.
It takes a minute. Okay, so we'll tweet it out in a little bit. My quick recap on this thing is it was a good report. You can look at most of the internals inside of it. We had 250,000 jobs growth. The expectation on Wall Street was 188,000, so a big number. And we were wondering about whether or not the hurricanes, there's Hurricane Florence in September, Hurricane Michael in October, how they might affect the jobs report. There might have been a bit of a bounce back in that October data from the September hurricane. Something like leisure and hospitality was up by 42,000 on the month. It was 0 in the prior month. So there could be some of that in there, but bottom line is these are strong numbers. Unemployment rate unchanged at 3.7%. Well, why did that happen? You had a big influx of people into the workforce, and a lot of them found jobs, so you didn't have much of change at all in the unemployment rate. I'm going to pause right here, and let's see if I can tweet this link out, and then we'll take your questions. And thank you for joining us. There it is. It's there now. So I'm going to hit the tweet button, the retweet button, and I'll just say live now on this link. And then I can put that on Facebook too, right?
Yep.
Okay, so there I am. I'm looking at myself, which is a little bizarre. Okay, then here's this thing here. Okay. Okay. I think we're going to change this technology so somebody else does this for me in the future, but we're ironing out the kinks now. So live now on this link, talking about, Jobs Day. Okay, cool. All right, hold on. All right, now I have no, that won't send. I don't know why, but it won't send. Fetching preview. Okay, anyway, we'll do that later. Let's go to our first question. I have Laura over here helping me. She's going to read me the question.
What sectors are we seeing the strongest growth in, Steve?
Okay, what sectors are we seeing the strongest growth in? And for that, I'm going to turn to my handy-dandy table, which comes out from Reuters over this thing, and I'll read them to you. So sectors are kind of relative, right? The U.S. economy is a service jobs economy. Goods producing is a much smaller section. So we look relative to their sort of strength. 179,000 jobs created in the service sector, 67,000 in the goods producing sector. And that seems like a lot less, but that's a pretty good number in goods producing. And then manufacturing adding 32,000 jobs. That's also a good number for manufacturing, and also 30,000 for construction. I'm a little puzzled by the construction number because we hear all this negative stuff about the housing market. The housing stocks have been hit by higher interest rates, but there may be some building going on out there. Again, there could be a little hurricane effect. Retail, kind of weak. It's been sort of weak. Professional business services, 34,000. Leisure, hospitality, as I mentioned, 42,000. Government's kind of flattish, I'd say. It was -3 the last month, +4 this month. What else?
That's awesome. Could you talk a little bit about the tightening in the labor market and the labor shortage? Could that be an indication of a possible recession?
So the tightening, the question is, could I talk about the tightening of the labor market and whether or not that's an indication of a possible recession? So in and of itself, the tightening of the labor market is the opposite of that. It's the sign of a good, solid expansion, good, solid growth. But the way it could end up being part of a recession is this. Let me go back and talk about what's happened here, which many of you know. President Trump and the Republican Congress passed a very large tax cut along with an increase in deficit spending in December of last year. That's been criticized in part because it was a large amount of stimulus to the economy at a time when we were near full employment already, or what the Federal Reserve considered full employment. In fact, some of their forecasts show that they considered full employment to be 4.5%. We're at 3.7% now. So how does a tight labor market lead to a recession? Well, if the Fed gets nervous that this tight labor market will cause wages to rise above the level of the growth of productivity and the growth of inflation, then it may end up increasing interest rates more to slow the economy down. Now, the Fed does not want to cause a recession, but they do want to get the growth rate back towards the potential growth rate. That is a rate that doesn't cause a taxing of resources where there is some slack in the economy as opposed to no slack. So that increase of interest rates could, if the Fed goes too far, cause a recession. Thanks for the question.
Yeah, that actually goes along with another question we got, and just how the Fed watches unemployment rate and views unemployment rate. So if you could explain that a little more.
Well, I just had a chance to interview Janet Yellen, the former Federal Reserve Chair, and she sort of described the unemployment rate as her desert island indicator. Well, what does that mean? It means if you were marooned on a desert island and only had one piece of data, of course, only an economist would talk about this, then she would like to have the unemployment rate. Well, why is that? Because the unemployment rate tells you two things. It tells you the percentage of the total workforce that's unemployed. And so as it goes down, it tells you how much slack there is in the economy, and which would be diminishing at this point. As it goes up, it tells you that there's more slack in the economy. So as a guide to where you would put monetary policy, she thinks the unemployment rate is the best guide there. So the Fed has an idea in its head, and this is where it gets a little sort of fuzzy, I guess is the best way to put it. There's a thing called the natural rate of unemployment, which is a kind of steady state of the unemployment rate where it doesn't create inflation or it doesn't create deflation. That number has changed over time, to be sure, where the Fed and several economists think the economy can run a little hotter without causing inflation, and some of the reasons for that have to do with globalization, the ability to source goods and products and resources all over the place. But as that number comes down, the Fed gets more worried and starts to be concerned about inflation, and also thinks that the natural rate of interest or the neutral rate of interest should be higher. I know it's a lot of concepts in one answer, but you asked an interesting question. I can't tweet out the link here for what it's worth on Facebook, or I can't post it on Facebook.
We'll make sure to get you the link at the end.
Okay, well, but people who are watching on Facebook don't know where this is right now.
We have it posted on CNBC's Facebook page.
Okay, all right, I'll go there and retweet that. So go ahead.
So next question is, when do you expect to see full employment impacting corporate profits?
That's a great question. So the question is, when do you expect, I don't know if you can hear the question, when do you expect to see full employment affecting corporate profits? Well, I think it may be affecting it already. But the good news on that is there is scope for it to be affected. What do I mean by that? I mean that what we call profit margins are relatively high in the economy. How do we gauge profit margins? The total percentage of GDP that goes to corporate profits. That's been running relatively high. In fact, one of the big complaints or one of the big problems in the economy has been how a dollar of profit or a dollar of revenue is split between capital and labor. Capital has been doing relatively well relative to historic norms. So the idea that you could have some shift back from capital to labor, that is, labor could get higher wages, certainly means a reduction in profit margin, but it doesn't mean companies will be unprofitable. There's scope for companies to pay more and still make oodles and gobs of money without, and there's also, to my mind, secondary payback to the economy. You pay people more money, they can spend more and buy more stuff. So it's a frontline loss, but you may get it back the other way. So companies can still be very profitable. Ultimately, I would say there is some decline in profit coming from the idea that the labor market is tight and wages are going up, and so companies have to pay more in wages. And by the way, another way they're also attracting workers in this tight labor market is by boosting benefits out there as well.
Okay, next question is about the technology and the labor market. Do you believe that technology will continue displacing people from the labor market, or is it going to offset our shortage longer term?
So will technology displace people, or will it offset, what's the other part of that? The shortage longer term. Yes and yes. So I'm a huge believer in technology. I'm not afraid of technology as some people are. Again, I'm trying to navigate to this thing to get this link up on Facebook, and it's not working too good. Give me one more second. I'll get to the technology question. I have this ancient computer laptop here, which is part of the problem. So, right, I could boost my productivity by getting a faster laptop. See, I'm hitting share. There we go. Share now, public. Okay, there it goes. Okay. All right, it should be on my timeline for all you Facebook folks out there. Instagram, I don't use so much. Okay, so the history of these things, and I think that's the best way to think about it, is that you have a technology come along, a big change in the technological regime come along, and it creates unemployment in the short run, but creates jobs, progress, and productivity in the long run. Any number of things. In fact, the long run can be very long. You could argue, and some economists do, that the computer revolution was an echo of the revolution of the creation of electricity, like several hundred years, like more than 100 years later. So your question is right in both respects, is why I answered yes and yes. Yes, it does put people out of work, but yes, it also is an answer to our worker shortage problem. In fact, if you look at Japan, which has a much larger worker shortage problem, in part because they're an older society than we are. They have many more robots than we have. I don't have the numbers off the top of my head, but what you might call the robot to population ratio, I don't know if that exists, but it's something I've been thinking about, is much higher in Japan than it is here in the United States. I think we're going to be getting more and more robots and more faster robots, and part of the reason why that will happen is in response to the need for robots and automation to do jobs that we may not have workers for. And I'll add one more thing, which you may think this political, but I believe that a very important answer to our worker shortage problem is immigration. We should be increasing immigration in order to increase growth, not decreasing immigration. And I'll go one step further, which I'm sure will make a bunch of people angry here. Those 7,000 folks who are on their way here, here's what would happen. If we let them into the country, they would decrease productivity, ostensibly because they don't have either the language skills or the technical skills that we need immediately. However, if we trained them and made them into stronger workers or had better skills, then they would increase productivity. But it's why we have the term in economics called human capital. And I know that sounds a little sterile or a little whatever the word is, but yes, we have this concept of human capital, and people are an input into the economy, and you need people when you have an aging society, which we do. The baby boomers are retiring, nothing you can do about it.
Great segue. We have a bunch of questions about the baby boomers.
Okay. Questions about baby boom. I'm the last year of the baby boom, just for you know, 1963 apparently.
So what's happening? How is their retirement affecting the job market?
Okay, so here's what we know. Baby boomers are retiring, inexorable. If I could tell you an economics joke, which is that Alan Greenspan many years ago in a speech at Jackson Hole said we don't know a lot that is for sure in economics. We have no Planck's constant like physics. He didn't say that part, but that is sort of true. We have some ratios that kind of exist over time and may or may not work most of the time. But we do know one thing, which is the vast number of people who are 35 right now, in 30 years, will be 65. I can hear all the laughter coming from social media all over the place. But the deal is this. The demographics are inexorable. The people are aging and they are retiring. There's something that's a little different, though, than what we might have expected, which is we knew 20 years ago or 30 years ago people would live longer. What we didn't know is that they were going to live better. So two things are happening. Well, at least two things are happening. The first thing is older workers are working in greater percentages than the prior cohort of the same age. So go back to, say, people who were 65 20 years ago. A higher percentage of 65-year-olds and even 70-year-olds today are working. You see this in your life, I'm sure. You know 65, 70, 75-year-old people who are working and, by the way, haven't skipped a beat. So that's one thing in terms of them being in the workforce. The other thing that's kind of encouraging, which is that living better means they probably spend more money than they otherwise would have. If you think about an old or frail person hanging out in their house watching television, as opposed to the 70 and 75 and the 80-year-olds now that are swinging right now and going on cruises all over the place and spending money and having a good time. I hope that's true for most of you out there who are watching. That's a very different economic outcome. So, yes, it does affect the economy. It creates what we call a dependency ratio, which is the number of workers per retirees or people not in the workforce that is rising in the United States, but it's not as bad as it could have been. And one thing I tell people to do, I don't want to start intergenerational wars or ruin your Thanksgiving dinner, but do the dependency ratio count at your Thanksgiving dinner. Look around the table and find out how many people are working and how many people are not working. And my guess is if you compare that to 10 years ago, your dependency ratio may also be going up.
Great answer. Can you talk a little bit about standard of living versus unemployment rate? If we're seeing more and more people joining the workforce, why isn't our standard of living changing at all?
So that's a tough question. Standard of living versus the unemployment rate. If the unemployment rate is falling, why aren't we seeing standard of living going up? I think we are, by the way. I think median income has been rising. This is a question for which we might schedule an entire session, which really deals with the issue of inequality and how we are, how the profits of the economy are doled out. I talked earlier about capital making more money than labor and why that is. Well, there are economists who throw out an idea called monopsony, which is that they own more of the means of, what's the right way to say it? Monopoly is when you own what's sold and they own what's bought. So in this case, they're buying the labor. And so the idea being that there is fewer and fewer employers out there, and so workers have less bargaining power. So that's one idea. There's another idea which has to do with technology and globalization, this idea that there is the ability to write an app and have that app, for example, be successful for you, not just in your state or in your region or in your country, but to have it be global and have those profits from that technological creation be global, which means it creates this very strong winner-take-all society. So it might be that there's an aspect of technology which is interesting because technology is also a kind of wealth-spreading idea as well. But there's an idea that there's this aspect of technology that is something that creates a winner-take-all and exacerbates inequality. It's not a great answer. There's much more to it. And I'm working on understanding this as well, but we do have issues of inequality. The idea is now one thing that is happening is we had this 3.1% year-over-year wage gains this month, and we are looking for better wage gains as the unemployment rate falls, and that will give employees some bargaining power, allow them to raise their standard of living. Another issue, obviously, people say is the fewer unions. So there's less bargaining power that way from employers for employees.
Okay, last question.
Last question. Sorry, folks. Maybe we'll do this again if you all had fun.
What should we be looking ahead for in November?
Looking ahead for in November. Well, it's still fishing season for me, so I'll be out fly fishing as much as possible. I actually saved some vacation days for the month of November to fly fish on the Long Island Sound and a little bit the South Shore of New York. I have a lot of musical gigs coming up in November. I'm playing at Still Partners in Long Island. I'm also playing on Connecticut. And some people asked earlier, we'll be back, Stella Blues Band will be back at Garcia's in December. But that's not what you asked about. Here's what we need to find out. We want to know two things. Well, more than two things. We want to know a lot of things. Is trade having an effect on the economy? One of the things that spooked the market recently was this notion, some of the companies came out with earnings reports that blamed some of their shortfalls on tariffs. we actually did a pretty intricate study. I worked with our producer here, Nicholas Wells, and we looked at every single earnings call that was out there, and we found that tariffs were mentioned 35% of the time. And in that context, 19% of the time, it was mentioned in a negative way. So I'm waiting to see if there's any impact on trade and the trade numbers and thereby the economy from tariffs. The Fed, obviously we have an election. I don't think the election is going to be tremendously consequential for the economy. I think if the Democrats take over, it may be a series of investigations for the president, but I don't think there's much more that I think either side can do. President Trump has talked about making the tax cuts permanent. Not sure there's the support for that in a Republican Congress, in part because I do believe there's going to be some concern about the deficit. And maybe I'll close with this. There's one more jobs report. This is not a November thing, it's a December thing that happens before the Fed meets in December, which is mid-December. And my take right now is it has to be a very, 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 very weak jobs report for the Fed not to hike interest rates by a quarter point. So I think they'll fulfill 4 rate hikes this year. They'll have raised it by a percentage point. My best guess right now is somewhere between 2 and 3 quarter point hikes next year, which would bring the funds rate up towards about 3%. That's the short-term overnight lending rate from the central bank, which may mean that your mortgages might go up to, not if you have a fixed rate, of course, but if you're out there looking for a mortgage, into the 5.5% range maybe. But the good news here is that I think the Fed is maybe closer to being done than most people give it credit for. It's very close to sort of finishing up this rate hike cycle here. So except if these unemployment going down to bring it back.